Hi there, welcome to kneppyinvests and welcome to another answer and reply video. I've started this or recording this video fairly early in the day. It's supposed to be a warm day here, plus I have plans and I didn't really want to record this video in the afternoon. So those plans were from about 9 a.m. So I am time constrained. Time currently is 7:42 a.m. So let's get stuck straight into it. And the next few questions or comments were in regards to a JB Hi-Fi. This is probably in regards to their results or after they release their results. So one comment saying that JB Hi-Fi is their biggest holding. Nice to see some more green. That's from a name JZX Vecker 641. James Dean died in 1955. That is correct. Doesn't matter what happens. World War III, COVID-2, 2.0 recession, RBI hikes, interest rates to 20%. JB Hi-Fi continues to tick higher. I have to say, it seems like it, isn't it? But that's probably a sign. I'm going to say this right now. That's probably a sign of a high quality company, which is exactly the sort of companies you want to buy. Jakito Rio Taku talked about owning property, not really a share investor. But will there be another buying window to purchase JB Hi-Fi shares, or do you think it will remain this high even when consumer purchases subside and interest rates can drop? That's a tricky one, and that is the question. Now, let's have a look at a few things. First, the chart. So this is JB's Hi-Fi's chart. It's an absolutely beautiful chart over the past this is 1 year. So this goes back to about August of 2023. So share price has actually gone from $46 to almost $80. This is a beautiful looking chart. There is no ways around that. Now, JB Hi-Fi doesn't always look, or their chart doesn't always look pretty. So if you actually have a look at the weekly chart, share price of this company went sideways from just before COVID-19 all the way through to August, September last year. So this has been a period in JB Hi-Fi's life where the share price has rallied. Now, there will be also the possibility, maybe over the next few years, the JB Hi-Fi's share price just goes sideways for a few years. That is the truth about many high-quality companies. Here's another period for JB Hi-Fi when the share price went sideways for a few years. So this is sometimes you just see quite often, the share price will go on a rally and then does nothing for a few years. Another rally, nothing for a few years. Sometimes share price of a company goes up for 5, 10 years, and sometimes share price goes sideways for 15 years. Yes, I'm looking at you, Microsoft. Microsoft share price went sideways for about, I think it was 13 years, not 15. But over time, if you, in fact, have a look at the monthly chart, share price of JB Hi-Fi has gone up. In fact, if you have a look at this chart, the past week looks like the most impressive. Up 14% in the past month, so this is monthly, and 14% in the previous month. So it's gone up 2 months in a row. So it'd probably be a little bit healthy for JB Hi-Fi for it to just take a breather, just to go sideways. The other thing to keep in mind is the premium people are willing to pay for JB Hi-Fi right now. And if the market is willing to pay more of a premium, that means there is a possibility, a scenario in the future where the share price, even if the company does grow, the share price might not do anything because you get multiple contraction. So when you see the PE ratio of a company climbing through time, that's multiple expansion. The market is more and more willing to pay a premium for the company. When you see a PE ratio of a company go down through time, that's multiple contraction. The reason why Microsoft share price went sideways for 13 years is because even though the company grew, the multiple or the PE ratio of the company fell. The market was less and less willing to pay a premium for that company. So right now, JB Hi-Fi's, and this is according to FinChat, JB Hi-Fi's PE ratio is almost 20. Now, I'm going to have a look at the history. So just looking at the PE ratio of the company in isolation tells us nothing. We need to know what usually the market is willing to pay for this company in terms of valuation or PE ratio. So let's have a look at the history or PE ratio history of this company. Let's do it very quickly. There it is. It's in ratios. This is like over the past 10 years, by the way. And right now, in fact, the first thing I see here is 20 seems to be a lid. So back in 2016, the market was willing to pay 20. Back just prior to COVID-19, 20. Just after COVID-19, 20. And the lowest PE ratio has been around 8. That was in 2022, 2023. And that was just before the share price took off. So that was around the time when everyone was thinking, oh, we're going to move into recession. All these discretionary companies are going to be absolutely smashed. And that did not play out. So between about July 2022, July 2023 was an absolutely great time to buy shares in this company. So if we go back to the daily chart, so what was it, July 2022, July 2023, there we go. Share price of this company was below 40. And I actually did buy some shares at 40 in JB Hi-Fi. Then I sold some, bought back in. So that was, in fact, I still remember looking at JB Hi-Fi, forget exactly when, and thinking, oh, this company looks quite cheap at a P ratio of 8. I'm not saying that now. P ratio is 20. It doesn't get higher. You usually get higher than this. And usually, typically, don't want to say usually too often, typically, when it does get to 20, share price might sell off. So I don't know if now is the best time to buy JB Hi-Fi because the share price has gone on a run. P ratio looks quite stretched. That's the other thing. And the only way JB Hi-Fi can justify the current valuation is if it keeps on growing. So there are a lot of questions about this company right now. And this is the type of company where I want to see some value. And I'm not seeing that right now, even though I am trading and holding this company at this point in time. So thank you for all those comments. Infinity. Hi, Kneppy. What are your thoughts on RLF? I only recently stumbled across the company and wonder whether it would be a company you would want to invest in. RLF. The T code is familiar. RLF. Something tech. RL Agtech or something maybe. RLF Agtech. There you go. See, I sometimes do know companies, not that well though, but for some reason it just ag and tech popped up in my mind. I know nothing about this company. I just know the T code, and obviously I know a little bit about the name. So, a couple of things. Let's have a look at their preliminary final report. They released that at 4:17 p.m. last night, well, yesterday afternoon. And do they release Appendix 4C? So I'm assuming they do. So let's have a look at the last 3 months, and we'll open up their most recent Appendix 4C. Now, since I don't know anything about this company, I'm going to do this fairly quickly. So I'm going to go to the About section, which I hope they do have. Seems like they don't have it, which is annoying. I hate when companies don't have an About section. I want an About section. Okay, so their preliminary final report, they should have an About section here. Sorry, I was looking at the wrong one. So this is the Appendix 4C. They should have an About section here right at the end. Here we go. So RLF Agtech is Australian-based global plant nutrition company with a vision to empower farmers, nourish people, and restore the earth. Sounds interesting, intriguing. Now, it is an agricultural-based company, it seems like, and I'm not the biggest fan of those sort of companies because many things can go wrong outside the control of management. I have held Costa Group in the past, but that company's been taken out. And one of the things I did realize when I was holding that company is many things can go wrong out of the control of the company. For instance, supply demand, or bugs, or diseases, weather, things that are outside the control of the company. The only way they can get a little bit more control is to become significantly diversified. Costa Group was trying to do that, diversifying overseas, diversifying what they're selling and growing, that sort of thing. So RLF combines plant science with advanced chemistry and manufacturing practices to produce high-quality plant nutrition products. I'm not sure exactly what that is, but so the next thing I want to have a look at is this. And the first thing I note here was their Appendix 4C. I'm not sure why I have not had a closer look at this code because this one really, this is the sort of thing I'm looking for. A company that is operating cash flow positive, $1.8 million for the quarter. And this could be a one-off because for the year, they're operating cash flow positive $91,000. So this could be just a one-off. So I'd like to see a further proof that this company is starting to show a bit of scale, is growing, that sort of thing. They also acquired a business and how much cash they have on hand. So they have a little bit of cash on hand. Did they do a capital raising? Looks like they did. Much debt, a small amount of debt, $4.7 million. That's probably okay. What's the market cap of the company? 11.33 million doesn't seem too stretched. So what I'm seeing here is interesting to say the least. I'm not sure if I'll be willing to invest in this company right now. And the last thing I'll do is have a look at their Appendix 4E. So revenue down, profit down. So you can see that last quarter, operating cash flow positive by a fair amount, but revenue's down, profit is also down. So that's a couple of negative things. Let's have a look at a few of their. So the first thing I want to know is, why is revenue down? They made a fairly big loss. So let's move on to assets. $3.5 million of assets, net assets or equity. So that's a little bit concerning. What assets do they have? Bit of cash, bit of inventories, a fair bit of intangible assets, which is their probably biggest assets there. And they do have a little bit of debt, as we have already found out, which is a slight concern based off the market cap of this company. And you can see a much better, in terms of the cash flow statement, a much better year. So just operating cash flow positive, and that's including government grants and tax incentives. So I wouldn't be quite there yet for this company, but it looked like a really good last quarter. I probably want to know why they had a really good last quarter. Maybe there was a one-off thing in there. They probably mentioned it somewhere in their commentary. They have got a strategic plan. I do like strategic plans. Not all companies seems to have strategic plans. Anyway, based off what they do, there are a lot of questions. Based off their finances, there are a lot of questions. But the last quarter makes me go, I need to do a little bit more work on this company. Let's have a look at the chart for RLF. I'm going to see if this chart or this company is in my watch list. I have a feeling it's in my agricultural watch list. Look in the chart. The first thing I see here is not there yet. So I will not consider this company high quality. So when it comes to high quality companies, I want to buy those at good value. I don't care about the chart. But for low quality companies, and I wouldn't put, definitely would put Agtech there yet, because they haven't proved anything just yet. So what I really want to see is a bit of interest in the market, and we're not getting that just yet because the share price has been a downtrend. So I want to see a bit of interest in the market before I even think about taking a position in this company. That is the way I view these type of companies. Now, the best way to get the market interested is to become operating cash flow positive, free cash flow positive, profitable on an ongoing basis. So I'm not there just yet with RLF. But one of the reasons why I'm not there yet is I'm a little bit more risk adverse. If you're a little bit more of a risk taker, maybe you're 23 years old, this could be one of the risks you take. And it could pay off. Hi, Kneppy. Thoughts on TRP? So this is one. Is this tissue repair? TRP? There you go, tissue. I was going to say I don't know this company. Tissue repair. Same thing with this company. Now, I have a feeling, does this company have any cash flow? So I'm going to do the same thing here. Look at the cash flow. What do they do? Repairing tissue, I'm assuming. I think I've had a look at this company before, fairly quickly. Phase 3 advanced biotechnology company developing second-generation wound healing agents. There's quite a few of those companies around. So tissue repair is one of those. Phase 3 is interesting. So if they said they were phase 1 or phase 2, I'd be probably less interested. So for me, it's all about whether their phase 3 trials, they're going to be successful. I have no idea because I'm not following this company. And I'm assuming they have no or very little receipts, $67,000 in the quarter, $165,000 in the year to date. So and they're burning through cash. So my opinion of this company is a story stock. In your opinion on this company comes back to its technology. Do you think this company can succeed? Do they have any trials they should be announcing soon? That sort of thing. TGA approval granted for tissue repair TR Pro. That sounds like an interesting announcement in itself. They also released a presentation alongside the cash flow statement, so I'd like to see that. Don't have enough time. They also appointed a new CEO, Tony Chirara, co-founder. Anyway, so the next thing I want to look at is the chart. So is there interest in this company? I have a feeling there is, because this company has popped up recently. Yeah. So obviously that TGA approval, yeah, that's when the share price rallied 95%. And Even though we did see a little bit of a dip in the share price has rebounded from that dip. So it's a nice looking chart. I'd like to see the share price get above 44 cents to continue the momentum moving forward. Some really big volume coming in when they got that TGA approval. I'm assuming that's what happened with the share price. 25th of July. Let me just confirm. Yep, that was it. That was the catalyst for this company. So this company could be on the precipice of hitting that inflection point. So I definitely want to follow this company a little bit more closely. Let's have a look. So I have this in a few of my watch lists. High volume spec, a buy by Australia, which means I follow this company a little more closely, but not the company itself, just the chart. Also have it in my IPO watch list, which means this company IPO'd within the last 3 or 4 years, and I have not had a look at the company in depth. So it listed, there it goes, late 2021. So what I do, I have an IPO watch list. I put companies at IPO into that watch list. And then when I have a closer look at that company, I take it out of the watch list or out of that particular watch list and put it into a new watch list. So companies can be in numerous watch lists in TradingView. Other than that, I don't know. I don't know anything about the technology. Tissue wound repair sounds interesting, but they did release something that does maybe require some closer looks. But again, how much money are they going to get if they start selling this tissue repair TR Pro? I don't know. Do they mention it in the announcement? I don't know. Despite the product's current regulatory status as cosmetic TR Pro, sales in June reached a new high with Q3 revenue showing 130% growth. So they actually are selling something. So that's better than a company that's not selling anything. And what's the market cap of this company? TRP? 25 million. It's not that too high, it seems like. Yeah, I'm going to have a closer look at this company. I should write this down. I'll write it down later. Have a closer look at tissue repair. Thank you, Mr. Vet Pow. Don't have to comment. Nice, 00742. Great job as usual. That's showbiz. Would it be good to see what you think of Deterra Royalties, especially with their recent new asset purchase? I have actually taken a position in this company, and I think there was a little bit of selling in Deterra because they made this purchase, and they also mentioned they will be decreasing the minimum of their dividend payout ratio to 50%. So people freaked out, believing they were setting their dividend payout ratio to 50%. It wasn't. It was a minimum of 50%. There is definitely a scenario where they're going to keep on paying 100% dividend payout ratio. So I do think people got that wrong. So where's the acquisition? I forget where. Was it Trident Royalties? Yeah. So it's all based off dividend. And don't forget, Australians are obsessed with dividends. We saw that with Yancoal. Drop your dividends, share price tanks. A few of the biggest companies on the ASX had, in my opinion, normal, ordinary, not that good financial years, but they raised the dividends, share price rallied. That's all it seems like many investors care about, dividends. In fact, I have heard some people say, if a company raises dividends, that's all you need to know. That's a sign of a high-quality company. That's not true. For instance, let's have a look at CBA. Because everyone loves, well, I wouldn't say that. The PE ratio and the valuation of this company is insane right now. If you have a look at their historical dividend payout, that's flat. So they just increased it to get to a 10-year high, but overall it's just flat. So they haven't really increased the dividends all that much over the past 10 years. A few companies have done that, and that's why the share price of these companies have rallied. If you look at Deterra, for instance, I'm pretty sure the dividends of this company fairly flat as well. There was one good year in 2022, but I do think this is sort of the company where it's more of an income play, 5.8% dividend yield. Now, my thinking, and this could be complete horrible take, is that people have panicked. They've sold off the company. So I bought some shares at $4. So share price right now is $3.68. So my thesis is not working right now. And just based off the chart looks horrendous. And I do think the reason why people are selling is because 50% dividend ratio, we're used to 100%. But if they keep maintaining 100% dividend ratio, the share price will rally. And I think the share price could get back up to $5, even $5.50, particularly if this acquisition does really well for the company. So I think now is a good time to think about buying some Deterra Royalties. Now, if you have a look at the weekly chart, the share price is at COVID-19. No, is that COVID-19? Not quite. is at the lows this company saw back in September 2021. So I do think right now is a low risk. It's a low risk play for Deterra. I think this could be near the bottom. So this is more of a longer term play, and I want to see the share price get back up to definitely above $5 before I think about selling. So that would be a 25% capital growth for my holding plus the dividends. And there's even the possibility, if this acquisition goes well, dividends could rise, even if the dividend payout ratio goes down. The other reason I like what they're doing is it gives the company more flexible to grow in the future, because otherwise I don't think the company could grow all that much. But again, dividends rule in Australia. If you go to America, they don't care. In fact, most countries don't care about dividends, nowhere near as much as Australians, and it does harm does actually harm our country, because dividends suppresses innovation and growth. Anyway, so that's I have no opinion on the acquisition itself, because it could go many ways. And that's what happens with acquisitions. They can go many ways. There has been research done that shows the bigger a company is, the less likely any acquisitions are going to be beneficial for shareholders. So research has been done on that. So smaller companies, when they acquire other companies, there is a better chance those acquisitions will be better for shareholders. But once a company gets big, acquisitions tend to go badly in the main. Anyway, that's I'm trying. This asset purchase, I believe it was a diversification play, because I had a quick look at it and I went, oh, they're diversifying. So really they're really concentrated in iron ore. And I believe, in fact, let's have a look. I believe they would definitely, there should be a presentation somewhere. Where is it? By the way, this is their dividend or payout ratio. Was this one? Yeah. And they say minimum, not sitting at 50%, they're saying a minimum. And it's all going to be based off. Here it is. Where is it? For subsequent periods, the Deterra board is targeting a minimum dividend payout ratio of 50% instead of 100%. So there is a possibility where it's going to be 100% every single year. Anyway. They also might have increased their debt. So I believe this is global. This company has assets around the world. I'm trying to find it. I'm going to won't be able to find. There was a presentation. I'm pretty sure there was a presentation. Maybe not. Corporate presentation. Maybe it's in this one. Because I'm pretty sure I saw some pretty pictures, and I am attracted to pretty pictures. Not that sort of pretty, you know what I mean, just nice little pictures. Let's have a look. Here we go. Pursuing value through growth and diversification, sort of what I said. I just want to see if they've got a map. I just remember seeing a map of where their new assets are going to be. And I could have been this one. Yeah, it was this one. It was this one, yeah. So they've got assets all throughout the world. So we're talking about Africa, South America, and also United States. And not only that, gold, lithium, copper, silver, sugar zone. Not sure about that. So a fair bit of gold and that sort of thing. Some of these are producing, advanced, and exploration. Also one in care and maintenance. 21 assets, 12 cash flowing assets, 6 commodities, 11 countries. So they're definitely way more, or will be way more diversified moving forward, Deterra. So for me, this is an opportunity to buy this company at possible good value. But also, there's a possibility you might get a nice little capital return from it, and also a dividend return from it as well. That's Deterra. Oh, you've asked another question on that. 2 questions in a row. Each day trades for BF. By the way, did you notice EVN time to release their cybersecurity incident at right timing, coinciding with US inflation data, positive for gold and positive financial year results? I did not notice that at all. I'm just going to have a quick look at Evolution Mining chart. I'm sure you meant this one. Because the reason I want to look at this chart is because the share price broke out the other week. So I've got this line here. I want to see share price get above this line, just above $4.10. And I noticed the share price got above that level. Even if you look at the weekly chart, it looks pretty good in the weekly chart as well. So Evolution Mining looks pretty good at this point in time. So coinciding with the release of their results, if I remember correctly, it was like 2 or 3 weeks ago. Let's see how wrong I am. 14th of August. Yeah, 17 days ago. And I think the results were pretty good. And the market responded fairly well as well. Anyway, but otherwise, what you mentioned there, no idea. Yep. Companies I own, go companies I own. Yeah, oh, yeah. Oh, yeah. Well, we all biased when it comes to companies we own. We all want the companies to own to do really well. I don't want to brag too much, but my superhero portfolio went up. What was it? 2% yesterday. Slight brag there. And when that happens, I just want to take a screenshot of the day and then go back to it on a bad day. Go, good days do happen. Good days do happen, particularly when you significantly beat the market. That's when you should think on those really big down days, good days happen. And just remember, good days happen. Thornley Photography, LIC or Lifestyle Communities own a lot of land. Interest rates shouldn't go much higher. At some point, it has to find good value, don't you think? Yes, I think there's always a point for companies when they look good value, except for a company that might be going bankrupt. Yes, I'm looking at you, Mosaic Brands. So I'm going to just take a little bit of a detour here. Mosaic Brands share price dropped, was it 30% yesterday? They have delayed the release of their financial results. It's not a good look. The market cap of this company is like $5 million. I think the market is pricing in this company going bankrupt. Yeah, I wouldn't be surprised. So watch out for that. So for Mosaic Brands, yes, there is no price at this point in time. But for every company, there will become a point where the company looks really good value. For Lifestyle Communities, I'm not sure where that is. And the chart looks horrendous. So there's so much selling. What I would like to see is share price just keeps on falling. And you could say there's really good value in this company right now, and the share price keeps on falling and just keeps on falling and keeps on falling. So the questions I would have, do you think this company is high quality? If so, is it good value right now? And if you say yes and yes, now could be a good time to take a position in this company. For me, I am like skeptical about whether this company is high quality, and I don't know whether this company is value or of value right now. So that's where I am for Lifestyles Communities. It's had a really good run, or did have a really good run. So if you look at the weekly chart, a beautiful looking chart. Share price broke out back in October 2023. Let's have a look. There it is. There's the breakout. Not sure why, but it definitely broke out October 2023 at a share price of $1. Share price went from $1 all the way up to $23. So 23 bagger over a 10-year period. But just because it went through a 10-year period when the share price went up a lot doesn't mean it's going to continue. Not only the share price now is at a 4-year low. And the chart just looks horrendous. I just keep going back to the chart. Now, a few things about this company. Let's have a look. I haven't had a very close look at this company. This is not the sort of company I do like. P ratio, this is according to FinChat, is 17.8. Now, that could be suppressed because of a bad year. I don't know. I'm assuming this company has had really good revenue growth. Yep, it's revenue growing really nicely. And let's have a look at the income. So the profit did fall. Just having a look at this. Profit did fall a fair bit in the last year. So the last 3 years, the profit of this company was between $80 and $90 million. So there is a possibility where the profit could go back up to those areas in the next few years. And this company is looking cheap right now. Now, there has been some bad publicity about this company in the recent months, and that could have a bad effect on the company. So I think there are a few questions about Lifestyle Communities. But the chart for me is so negative, and there's so much negative sentiment in this company that I'd probably, personally, I would just wait, even if I thought there was good value in this company right now, which I'm not sure of. Karat Singh, a reverse discounted cash flow. You're pretty excited with Pro Medicus results, and I agree. There's valuation concern with Pro Medicus. 150 might be tough wall to break. Yeah, everything you said is absolutely true. Pro Medicus is at $150.70, by the way. You might say now 152 might be hard to break. But look at this chart. Compare this chart to Lifestyle Communities. for those who skip to Pro Medicus, Lifestyle Communities, which is the last company I looked at, chart looks completely opposite to this over the last year or so. This is a beautiful looking chart. Now, I am of two minds when it comes to Pro Medicus. Now, this company is growing at a phenomenal rate. The margins in this company are extraordinary, and they keep on growing. Look at the revenue growth. So the revenue growth in itself is beautiful. Income, beautiful. Growth. We have everything here pointing to a high quality company. Could this be one of the highest quality companies on the ASX? Gross margins keep on increasing at 90. Well, I'm going to get rid of gross margins and look at operating margins. How's that? Operating margins keep on growing. In fact, there has not been 1 year where operating margins have dropped. That could be coming in, I don't know. But the P ratio of this company currently is 190.52. Now, the problem with that is just like, again, Microsoft back in 2020, Microsoft grew, but the share price went sideways for a long period of time because even though the company grew, the P ratio of that company kept on falling. So more than likely, Pro Medicus won't see any multiple expansion from here. I don't think we're going to see the P ratio much higher than this. It would be extraordinary if we do. But I probably said that when the P ratio was 150. I might have said that when the P ratio was 120. But really, the only way to justify the current share price of Pro Medicus is significant growth over the next 5 years. Significant growth. And they might achieve that. I did do a reverse DCF on this company. Also did a DCF on this company. I'll talk it briefly now. And I did get a fair value using a wide range of different variables. I did get a fair value based off their potential growth of around about $80. So if I saw the share price of this company fall to say $60, I think that's good value for this company, even though the P ratio would even then be quite high. So significant growth needed for this company to justify the current multiples or valuation, whatever you want to call it. So yeah, this company keeps on surprising me. I keep on thinking I should take profits. I have been thinking about selling half of my position, just taking the profits. I don't think if I do go down that route of taking profits, I don't think I'll sell out of my whole position. But I just struggle to think how this company share price will grow much further from here unless the company significantly grows. Even grows at a quicker rate than they are doing right now. Roger H, TK, 5TK. I think Simply Wall Street charts consensus forecast with future lines from Hodlai maybe average. I'll have a look at Simply Wall Street. This was in regards to I want some site that shows me the expected or the consensus for a company's results because it's quite important. I can get it for American companies thanks to NASDAQ, but I can't find it, have yet to find it for Australian-based companies because how the results beat or miss expectations is really important. And also future expectations. I want to see that. Now, you can find it, I found or discovered in FinChat. They do have somewhere, or they do have these forward. In the growth, they have this revenue forward 2 years, EBITDA forward 2 years. I don't know where they get that. Dividends per share growth forward 2 years as well. So they do have a 2-year forward-looking or expectations in FinChat. I'm just wondering where they get that. Anyway, so thank you, Roger. I'll have a look at Simply Wall Street. Forest Hill. Because of your videos and other content I'm watching, plus my analysis, I've got too many high conviction stocks, over a dozen on my buy watch list. What's your advice on how to decide? With limited funds, am I better off narrowing it down to a handful or should I invest a small amount in all of them? I should just answer, glad to hear it, because that makes sense. So I do like these recommendations sometimes. It does help me because sometimes I'll just click on it and reply. Good stuff. So, okay. What I would do is a dozen. So at this point in time, I don't have many companies on my high conviction watch list that I don't own. There's a few. Supply Network is one. I do have a few. But when I have quite a few, I list them or rank them in terms of my conviction list or how highly convicted, or whatever you want to call it, how judge them or rank them by conviction, probably the best way to put it. So my highest at the top, lowest at the bottom. Also, I look at valuation. Which one is really good value? And even if that is on the lower or towards the lower end of my conviction rank, and I think there's better value in that company, I might buy that. There's also an argument that you take a smaller position in all of these companies, and then you add to those positions over time. So there's also that scenario. If I had a choice, I would probably go down that route. Or otherwise, even if you go down the other route of buying the ones that look better value, who knows? That could go wrong, because not all of these high conviction stocks are going to do well over the next few years. Hopefully they all do well, but I personally would probably take a small position in all 12 of them, over a dozen. It also depends on how many you got. If you got 50, that's different than 12. So if you only had 12, I'd take smaller positions and then add to them over time, particularly, and this is just me going back to some technical analysis, particularly if the company releases some good announcements, a good result, and the share price pops up, add to your position then. That's what I would do. But everyone's different. I think you've got to find what might work for you. If you have a really high conviction on a few of these companies, maybe go down that route, particularly if they're pretty good value. But if you don't have much of a difference between your conviction, I would go down the small amount in all of them and add to your positions over time. Hopefully, I have helped. It's always good to get different opinions, I think. Roger, or maybe it's not Roger, Roggle or Dawn. Have you had a look at PNR, which is Pantoro? Yes, Gold Producer, that looks like it's rising off ATL. I have been looking at Pantoro for a long time. I first took note, PTR, PNR, what was I doing? I was going to say, I just put the wrong letter. Pantoro. So I actually first had a look at this company. It was many, many years ago. It would have been 2016, 17. And the chart, first thing is the chart looks really good. So this is another reason why I'm looking at this company a little bit more. The chart looks really good. There's a really nice buy situation with this company back in the start of August. It's a mining company, gold. So, of course, I'm more likely to trade this company than own it for the longer term. So the chart is more important for me than anything else when it comes to this company. They just released a presentation on the 5th of August. If I remember correctly, I did like their Appendix 5B. Let's have a look at that. Of course, ComSec is going to take ages to open it up. If I remember correctly, I think it was okay. So don't care about the highlights and all that. So yeah, I remember now. Yeah, so cash receipts 78 million, operating cash flow positive 25.5 million. So this, in my opinion, was a fairly good quarter. So I would like to see this continue in the next few quarters. But I think the market is saying, yes, this will continue because the chart looks pretty good. In fact, the share price broke out. It was a nice little breakout on the 13th of August. The share price on that day rose 13%. And you could have bought about 6 days later or after that at the same price, around about 10.5 cents. And notice, if you just put a line at 10 cents, again, 10 cents is a very important level. So even for Pantoro, it's very important. Got to 10 cents in July, pulled back, broke above 10 cents on the 13th of August, pulled back below 10 cents briefly, and then popped up back above 10 cents on the 19th of August and has stayed above 10 cents since then. So the chart looks really good. Other than that, their quarterly results look pretty good, but I don't know enough about the company to know if these core results were sort of expected or the company is expecting these sort of results to continue, because nice cash flow, really nice cash flow. In fact, the cash on hand grew. They did a massive capital raising too. So this company has a massive amount of cash on hand, $98 million of cash on hand. Well, they have a bit of debt, looks like. They paid off a bit of debt, yeah. So they really paid off their debt. So they use a capital raising to pay off debt and to increase their cash on hand. And what's the markup on this company? Let's have a look. 806.75 million. Okay, so really the company The market likes this company based off the markup and the chart. So I think this that particular quarterly results probably not that unexpected, particularly because the share price didn't roll higher from it anyway. So I do like the chart for Pantoro. 9-slide glide says, thanks for covering Fiducian. To clarify the earnings multiple, the underlying earnings per share was 56 cents. Based off the closing price of today implies a multiple of around 15. Did I make a mistake there? If I did, thank you for correcting me. Sometimes I can go through the companies fairly quickly and mess up. That was a mistake in itself. It was not planned. Mess up, not mix up. Rick Thelian, ASX dropped lower in later trading. Morning was higher. Origin lost $1. Baby Bunting dropped lots, as did KMD brands, now just rebounding a bit. Thank you, Rick Thelian. What day was that? Not sure. I'm not sure I'm going to have a look at any. Oh, and I'm going to have a look at a few charts here. We'll have a look at Origin. I'm pretty sure the share price of this company dipped back on the results, if I remember correctly. Yep. Dipped back, down 9% on results, the 15th of August. And the share price has recovered since then. This probably would be a case where I maybe not want to panic on open or anything like that. Even the next few days, share price hasn't dipped any lower. I would probably be still holding shares in this company if I was a holder. Baby Bunting, this is just based off the chart, by the way. Baby Bunting, I'm pretty sure they released results the market did like. Not a breakout, very close to a breakout. Shares actually dipped lower the next day on the 21st of August. I'm not there just yet with the chart for Baby Bunting. We can see the share price on occasion getting above the longer-term moving average channel. We saw it first happen in August last year at a share price of 225. We also saw it happen back in March, briefly above, and now it's briefly above it. Does not mean it is turning around, but possibly sentiment is starting to shift from really negative, not quite positive, maybe neutral at best. And what's the other one? KMD brands. So someone did mention that this company is pretty good value at current levels, and the share price has taken off. So what we could be seeing here is value investors just seeing value, and the share price has taken off. Share price has risen from 32 cents to 53 cents. Chart does look interesting. So this could be one of those not quite V-shaped recoveries, but maybe the bottom is in for KMD brands. And look at the volume when the share price hit the bottom. Volume really expanded as the share price was approaching that bottom. That's actually a good sign that the bottom is almost being reached. I would like to see high volume as the share price increases, but we're not really seeing that. But I think possibly the bottom is in for KMD brands. Thank you, Rick Thelian. Hutcho, I heard Amazon is going to enter the Temple and Webster space, which will probably mean curtains for them. They said that with JB Hi-Fi over 10 years ago. Yeah, they actually did say that with JB Hi-Fi over 10 years ago. I still don't understand why people buy furniture online, particularly couches. I like to lie on the couch first to test it. So this is always interested me, why people buy furniture online. You could be right. I don't know. Maybe what you heard was rumors. I just don't know. At this point in time, let's have a look at Temple Webster. Or this is a trade I made because I thought, oh, share price is breaking out. Share price hasn't done really much since then. But I haven't got out of this trade because there is a chance share price could go higher from here. But this is just me saying, oh, share price is broken out. I'm going to leave my bias out, and I would be biased against this company. I don't think when you look at the valuation, I was like, it's not that attractive. But share price breaking out, I'm going to take a position in the company, and it might not work, but that's okay. I don't think I would lose much if it doesn't work. And I'm only down a little bit at this point in time. And there's a chance the share price could rally from here. I don't know. And again, possible Amazon could be a threat to this business. But again, they said the same thing about JB Hi-Fi 2012. I still remember taking a position in JB Hi-Fi when it was the most shorted company on the ASX because people thought it was going to be die because of Amazon. They might have not said die, but they thought it would wilter anyway, and never happened. T. Bandera always asks me complex questions. Please share with us the most successful trading strategies you have found based on your numerous years of experience. What signals and key factors do you look for in particular with small cap stocks? Do you believe in DCA investing, dollar cost averaging? Yes. No. Well, okay, this is a tricky one. It all depends on your investing philosophy. I think for those passive investors who just don't look at individual companies, index funds, that sort of thing, or maybe you do like individual companies, but you just own 15, 20 high quality companies, and that's all you're going to own. Maybe dollar cost averaging is fine. Every 2 weeks or every month, once you get paid, put some money into the stock market. That is fine. For me, my cash levels can fluctuate quite a bit, depending on my mood. Maybe not mood's the right word. On my sentiment. Am I a little bit more bullish or bearish? If I'm a little bit more bearish, my cash levels will rise. And if I'm a little bit more bullish, my cash levels will drop. I always like to have a little bit of cash on hand, just to take advantage of any opportunities. I like to be opportunistic. So I think it's all individual. For me, dollar cost averaging doesn't make sense. But for many people, yes, it does make sense for those. Because again, timing the market for those individuals is almost impossible because they just don't understand anything about the markets. Anyway, most successful trading strategies. So for me, my most successful trading strategies are breakouts, particularly when the share price has been consolidating. I have used this over the past 7 years, and it's been successful so many times, particularly when the share price is breaking out on positive financial news. Now, I have heard some people say you should not even look at announcements, just look at the chart. And they would just look at the chart and see a breakout and not even know why it has happened. And the company has released positive financial news, positive announcement, share price has broken out. So I've used this time and time again, and it's probably my most successful trading strategy. It's even been more successful than just buying and holding high quality companies. I like last year, 67% using that strategy, just that strategy. Okay, so that's my most successful trading strategy. So I'm going to try to find a scenario. So I could use anything. What should I use? Blue Scope Steel. No, I'm going to use Fortescue. No, I'm trying to think of a company that broke out on positive financial news. I'm going to use Dust Group. Yeah, Dust Group. And this one is an interesting one. Okay, so Dust Group listed on the ASX in late 2020. On the 29th of December 2020, the company released a positive financial update, so a trading update. In fact, I'm going to show you the trading update. What day was it? 29th of December. So most people on their break, but just because most people or investors, experts are on their break doesn't mean companies stop releasing announcements. So let's have a look at the announcement history of Dusk. I'm going to go all the way back to the start. So they listed on the 30th of October. And, I just gone ahead. There it is. No. Here it is. Trading update, 29th of December. So one of the types of announcements I'm looking for are trading updates. And they tend to be the most powerful type of announcement, particularly if it's a profit upgrade. Profit upgrades tend to be the most powerful type of announcement a company can release. Share price will rise. And you'll hear some experts say, well, you've missed the boat if you get in after the company releases a profit upgrade. That's absolute nonsense because it takes a while for the information to get out there. Not only get out there for the analysis to put their new numbers into their machines, and you can see benefits in terms of share price for 6 to 9 months. For Dusk, I think it was about 6 to 9 months. So this was a positive trading update. So I'm not sure if it was a profit upgrade, but it was positive. Yeah. The commentary was positive, everything positive. I'm not sure if this beat their guidance in their prospectus. I'm not seeing anything written, but I just saw this and went, yep, take a position in Dusk. Now, as I mentioned before, I've done my own research on this. When a company releases a positive announcement like a trading update, the benefits can last 6 to 9 months. Then after about 6 to 9 months, the benefits die away. They fade away. And when I say benefits, typically the share price performance of these companies significantly beats the markets. But after 6 to 9 months, the performance doesn't significantly beat the market. And you can see that with Dusk. They released the profit upgrade or the trading update on the 29th of December. Share price increased 12.8% on that day. So again, some experts will say, you missed your boat. Share price has already increased. You have to be in before they release the trading update. But look what happened. So share price went on a nice tear, was in an uptrend. The uptrend showed signs of falling away in July, 6 to 9 months. Share price got to a high, in fact, in July, 6 to 9 months. Again, and the share price has not been higher. I've got instances like this time and time again when the share price has broken out on positive financial news. I've mentioned Neuron Pharmaceuticals time and time again. And I was even told at the time, why are you buying this company? Share price has increased 100%. You're nuts. So they released positive phase 3 trials. Not only that, on the successful phase 3 trials, they're going to receive a lot of money from Acadia, a buckload of money. Share price on this day rose 91%. I was following this company for 10 years before this date. And when they released this announcement, I went, ooh, time to buy right now. I did not wait. Although I did wait to the end of the day because that's just the way I play. Share price opened on that day at $2.50, closed at $3.25, up 92%. And I bought at the end of trading that day, I think. And I bought at about, no, I didn't buy at close. I bought at $3, so just before closing, around $3. Anyway, you could have bought the next day below $3. You could have bought a month later below $3. But look what happened over time with Neuron Pharmaceuticals. Now, this was not one that went 6 to 9 months. This was definitely not that scenario because this was successful phase 3 trials. And they were going to possibly release really positive news years after this. And they have continued to release positive news. Now, I did take profits along the way. And it does look like right now the share price is turning down. So this is what I have found to be the most successful strategy for me. Breakouts on positive financial news, particularly. Not always. I have taken position in companies that have broken out on no financial news and would go to blue scope still. Companies I have, all these companies, well, except Neuron, blue scope still. I wonder if I still got where I bought in this. Oh, no, I got rid of it. Damn it. Yeah, I got rid of it. So I bought just here. It was August 2020. You can see the share price starting to move into an uptrend. So I bought sometime, actually, I think I would have bought in October. Right here, I think I would have bought. And there was no financial news. The share price just started to move. It was already moving in an uptrend, and that was confirmation on that particular day. And then I sold, I forget where I sold. I think I sold after this. Share price went to $26, started to pull back, and at this point, it was pretty obvious the uptrend had come to an end. So this was not a situation when I bought on the back of positive financial news. So that 6 to 9 months was not in play. This was just me looking at the chart and going, I think the uptrend is coming to an end, and I sold out somewhere here. So it was about 1 year later, but just over 1 year later. But I bought at what was it, about $13, and I sold about $21. So it's a nice little profit in a short period of time for a company like this. And if you look at the weekly chart since then, share price really has done nothing. It's about $20. So it hasn't done anything since I sold. Anyway, so thank you, T. Bandera. And I think the other thing I should mention here is everyone's going to be different. And one of the things I did like this one guy say, I forget his name, he said, there's a lot of trading strategies out there. And what you have to do is find the trading strategy that suits your personality. And I absolutely believe that. I hate when experts say there's only one way to invest. My way is the only way to invest. I hate that because everyone's different. So when I heard this trader say that, I went, this is the type of guy you want to follow because he doesn't say this is the only way to trade. You have to find what works for you. And that's very important. You have to find what works for you. What works for me is this breakout strategy. It's done fabulously well for me over the years, but it just suits me. Jack Sue says, Beamtree is breaking out. It is, I believe, broken out. It has broken out, Beamtree. They did release their results the other day, and I had a look at the results, and I was like, ugh. I wanted the company to release really good results, but the share price is breaking up. So this is, I'm not sure if this company is breaking out in the back of positive financial news, but the other thing I look at is volume. So I didn't mention volume in the last bit of the video. Volume, you can see the volume expanding, particularly from May, and we have seen a massive explosion in volume in in August. And that coincides with share price breaking out. In fact, I've got this little cross here. That is the share price breaking out. That's my little signal. Share price breaking out on the 9th of August. And I could have bought on that day, the next few days, at 28 cents. Now the share price is 31.5 cents. So not much higher from when it broke out. This was a sort of situation where I just wanted to see the company's financial results. They released results on the 27th of August. And does this company do Appendix 4Cs? I can't remember. No, they don't. So it's all about the results. And I remember having a look at the results and going, I'm not sure how the market's going to react. Well, that's the wrong one. So yeah, profit of negative 5.3 million, reported EBITDA negative 0.5 million. So haven't quite hit that inflection point just yet. I thought maybe they would have during this financial year, but not quite there for Beamtree. Scott keeps looking at my watch because I do have to end this video at a certain time. Scott says, many thanks. Doesn't seem like the offer bid spread suffers too much with MYG, which is my worry with illiquidity. I thought BFL was worth mentioning with so much talk about pricey banks are at the moment. BFL, which is BSP, I believe, which is Bank of South Pacific, seems to have a nice niche in its sights. We'll start with MYG. This is the one where I think the market completely misread their results. You see the share price dive. It found nice little support now, but this is a more of a long-term play for me. And the share price is still an uptrend. Yeah, I'm not going to talk any more about Mayfield Group. Let's have a look at BFL, which I'm pretty sure is BSP Financial, which is Bank of South Pacific, and up 4.4%. This is one that got away from me. I saw the share price pull back here back in March, and I went, oh, a nice little pullback, and I just didn't hit it. But there's this one, and also Kina, I think it's KSL, Kina Securities. This is also a bank. If you have a look at the financials of these companies, there's nothing wrong with these companies. People might say, well, they're in the South Pacific and Papua New Guinea. There's higher risk. Whatever. I think there's higher risk in Australian banks because they're so overvalued. P ratio of Kina is 6.6. Oh, yeah. And also the charts for both look pretty good. BFL, and this is based off ComSec, which could be wrong, by the way, a P ratio of 7.6. So let me just verify that. BFL. The other thing I'll do is look at the price to book ratio. So P ratio is 8.1 according to FinChat, and the price to book is 1.87. I probably would prefer that to be a little bit lower, but again, the chart looks pretty good. If you have a look at the weekly chart, nothing wrong here. It's in a nice uptrend. And the other one was Kina. And no, that's the wrong one. So both of these companies, I have thought, they both look really interesting. Also, the dividend yield is probably quite high for both. Dividend yield of 9.9% for Bank of South Pacific, or BSP, and I'm assuming it's fairly similar for Kina. So P ratio of this one is 7.9 according to FinChat, and the price book is 1.24. So we're getting to nice value for Kina Securities, and the dividend yield is 10.2%. And I don't think you're going to see much decrease in their dividend payouts. Let's have a look. In fact, dividend growth for this company, Kina Securities, is 2.7% over the past 5 years. That's a good sign. And for Bank of South Pacific, it is dividend growth is 0.97% over the past 5 years. And the chart for Kina, this is another one that I was having a really close look at, and there was a dip. Here's that dip. I think this was when they went ex-dividend. I have a feeling ex-dividend in June. Oh no, something happened on that day. I forget. Share price pulled back and it recovered almost immediately. And that's probably why I forget, because the share price recovered and I lost my opportunity. But I saw that dip and went, oh, now's the time. And this actually looks like a really good chart. This is a sort of chart I'm attracted to. And I reckon it's one of the reasons I think is because the valuation. This company looks really good value at current levels. Now, there is maybe a perceived sovereign risk, but I would say Papua New Guinea is going to grow at a significantly greater rate than Australia over the next decade, next 20, next 50 years. I think that's almost certainty. So Papua New Guinea and also other countries in the South Pacific are going to grow at a much greater rate. And these banks could be significantly bigger banks in another 5, 10, 20 years. That's the only thing. Well, that's maybe not the only thing, but that's one of the things that really attracts me more to these banks than Australian banks. You also get a nice dividend yield. Okay, so that's those two. Thank you, Scott. What do you think about TIP? TIP. TeamInvest. Is this TeamInvest from if you do watch Ausbiz the Core, so you have Howard Coleman, Mark Morland, and there's another guy. Is this the same people? I'm probably assuming it is. Let's have a look at the annual report and we'll see. It's going to take a while for this to open up. What do I think about the TeamInvest investing philosophy? You probably know it if you do watch Ausbiz the Core. So they are focused on non-volatile, high-quality companies. So they want assurance about how the company is going to perform over the next 5 to 10 years. And they do fairly well using that strategy. So they hate non-profitable companies. Absolutely hate those companies. They hate low-quality companies, which is fine. I'm just going to have a look at the CEO. Just want to see if this is the same group of people. Andrew Coleman. So I wonder if that's the son of what's his name? Howard Coleman. I don't recognize any names. So I would not be. They use a new metric here: money on invested capital. Never seen that before. I've never followed this. I've looked at this company before, so I'm assuming this is just like a fund manager. And the only reason I would buy into these sort of companies, there's a nice little company presentation. I might get some more information here. Maybe they tell us what they invest in, that sort of thing. It could be private companies. Maybe they're more like that. Is an ASX listed investment house focused on compounding wealth, knowledge and wealth. What do they invest in though? That's what I want to know. I want to see if Andrew Coleman is a son of Howard. Active investments, typically 10 to 20 assets, predominantly unlisted. Okay, that's interesting. So they don't list in, they don't buy listed companies. So that's interesting. Unlisted acquisitions typically on 4 to 7 times PE versus 15 to 25s for listed. They do make a really good point that unlisted companies tend to be significantly cheaper than listed companies. Listed investments offer greater liquidity at higher price. What's also true. So if you buy unlisted companies, it's harder to get out of, which can be a good thing and bad thing. So here's one company they own: East Coast Traffic Control. Straight away, I don't like that company. I'm not a fan of those sort of companies. GLT Trailers Redefined, probably not the biggest fan of that company. TeamInvest, they own themselves. Seems like, yeah, that's financial education business. Okay, that's the TeamInvest we hear about on Ausbiz the Core. So they've invested in that. And we can actually see what companies they invest in. Data3, Accent, Nick Scali, Credit Corp, NIB, Corporate Travel, Coden, ARB, Mineral Resources, Cochlear, Technology One, Breville, Pro Medicus, JB Hi-Fi, and Magellan Fund. Passive investments, case study, conscious investor fund. Okay, so my opinion on this will be dependent on the chart. Simple as that. Does the market like this? And the answer to that is no. In fact, the chart looks pretty bad. In fact, the chart looks horrendous. Anyway, that's all I'm going to say about TeamInvest, or whatever it's called. Liam Jones, Zip SPP is closed. We're all now locked in, so it's nice to see some huge greens. Monday cap raise results announced should be a reaction. Yeah, so I forget what the SPP was, but the share price is significantly higher than it is now. So sometimes it is really beneficial to take part in an SPP. What was the SP? I forget. It was like $1.70, $1.80. I could be completely wrong. I forget. Here it is. $1.70, $1.80. $1.56. Wow, I was completely. You're in profit right now by a significant amount. And I'm going through the same thing right now with SRG. So I took a position in this company before the share price popped up on the release of the results and the acquisition. And they also announced an equity raising. And that equity raising was done at $1.80, no, at 83 cents. And I went, yes, please. And now the share price is $1.09. So this was a situation where if the share price was near the cover raising price, I probably would have said no. But because the share price is significantly higher and the share price keeps on going up, I said yes, absolutely. So remember, Zip did this cover raising at $1.50. So that was way down here in this little purple box, which is a support zone for Zip. There's me taking a position in Zip at $1.75, so I could partake in the capital raising. And share price, the chart looks beautiful. No complaints about Zip. As soon as the chart looks starting to look ugly, I'll get out. SRG, I took a position in this company because I'll show you what I did. So there's me taking a position just before the big down day on the 5th of August. They released something positive on the 23rd of July. I forget what. So that's me buying on that. Share price dipped. Then they released their results and I went, come on, people. This company's cheap. And then they also announced the acquisition. And what I've heard, without even looking at the acquisition, it's a good acquisition. And you can see how what the market thinks about it. Share price has absolutely taken off. And the volume, look at the volume also. So the market loves these results and also the acquisition. So that was a no-brainer for me, taking part in the SPP. And I did this through Superhero, and Superhero, they always say, make sure you've got enough funds. I went, you've got plenty of funds. I also had a choice. I went with, it's a 5,000, I forget what. No, it was like, no, 3,000 shares. So about $2,500, yeah. Anyway, so thank you, Liam Jones. It's always good when you participate in a capital raising and the share price goes higher and significantly higher from when you took more shares. So you could sell your Zip shares at a really good profit right now if you wanted to. Alessandro Zarate, thank you. I appreciate you more than you appreciate me. That's maybe not be true. I don't know. Raven says, I'm down, but because we live in Australia, it's bonds are mate. Context, I have no idea, but yes. James, yes, I think I've talked about this a few times, James. I do know you love Andin Silver, and I've mentioned it a few times because you just keep mentioning it. So I'll move on to the next one. Ben Hutchinson, oh glorious day. Hillgrove finally gets some love. Adriatic bounces hard, was at the bottom. Even Woodside. My dogs come out to play in the sunshine. Last time I looked, Hillgrove looked ugly. Hillgrove. But I'm not selling. Yeah, it looks ugly. So this is when you mentioned the share price on that day rose 7.4%, and share price now is low. I'm not sure what's happening here. Hillgrove looks ugly, but I'm holding my shares in this company. I think this company looks cheap. It's an Explorer company. Did they release results? Can't remember. Don't remember seeing anything. Yeah, I don't remember seeing it because they released it at 10 a.m. and I completely missed it. I don't think you're not going to see much in these results. I think it's going to be the yearly results. We're really going to see some good numbers for Hillgrove. Revenue 40.2 million, so not profitable just yet. I think we're going to see a really good second half, and I think when the market sees a really good second half from Hillgrove, you will see the share price rally. If they reveal a really good second half, if they don't, the share price won't rally. So I think the market is missing Hillgrove right now. What else did you mention? Adriatic and Woodside, ADT. This one is all over the place. Yeah, it's all over the place. So volatile, this one. I'm not sure why. I was interested. You can see there's a nice little uptrend for a few months from March through to May, and just a really normal uptrend. Not normal, but a really orderly uptrend. No volatility in there. You can see some days down a big, some up, big up days, but a really orderly uptrend. And then since then, it's all over the place for Adriatic and Woodside. This one, I think one of the things with Woodside is people are thinking there's value in this company, and that has led to some support at current levels. So between $25 and $27. Yeah. So at 13 days to go. Oh. So this will be my last one for today. This one is interesting, I think. Gary Smithers, Marley Spoon. Yes, they are dislisting. They possibly have already dislisted. Yep, Marley Spoon has delisted according to this. I'm going to see if it's out of the trading view. Yep, it's gone. So Marley Spoon were delisting off the ASX, and Gary Smithers has a problem with it. Why does ASX allow us to purchase shares into any company that is looking at delisting back on the 20th of June and allow investors to keep buying up shares until it delisted? Didn't realize, thought I'd buy in a penny stock and top it up every so often until it delisted. Marley Spoon is a reasonable large company. It's like being in a Ponzi scheme. Okay. This one, I could be a little bit critical, saying you probably should have known it was delisting before you bought shares. So I think I could also say you need to take ownership of your decision. So there was information out there that Marley Spoon was delisting. So hopefully you learn a lesson. Instead of buying shares without knowing what's happening with the company, have a look at some of their most recent announcements. Unfortunately, we can't have a look at the chart because I'm pretty sure the share price did dive a lot. Now, the reason why they allow you to buy and sell shares is because probably many shareholders want to get out. And it would be unfair on those people if they weren't allowed to get out of the company once they've announced they've delisted. So the information is out there. So I'm going to say that the information was out there. It was publicly known. So you had a lot of time to get out. So first thing is, be aware of any announcements the company has released. Take ownership of your decisions. And that's probably all I want to say. So it's definitely not a Ponzi scheme. You have to allow the market to remain open for Marley Spoon so shareholders can get out. And some people may have wanted to buy in because they're more attracted to Marley Spoon if it's delisted. I don't know. So that's all I'm going to say when it comes to that particular comment, that hopefully you've learned a lesson. So I was aware of Marley Spoon. I've never had a look. It's probably not true. I have not had a close look at Marley Spoon, but I still knew it was delisting because the information was out there. Okay, so that's all I got for today's video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.